So if you get this wrong, you are committing mortgage fraud. You will go to jail and never see your family again. No, I'm just joking. Okay. So welcome to the channel. I'm Jamie York, and in this video, I'm going to be covering whether you need to get a buy-to-let mortgage or a HMO mortgage on a HMO and what you can do about it to make sure you are doing it in the right way. But before we jump in, do me a little favor and hit the like button. It really helps push this video out to more people like yourself and hopefully help as many people as possible. So what is a HMO? Well, a HMO is a house of multiple occupancy, and essentially it becomes a HMO technically when there are 3 or more unrelated parties living in the same property. So you're still doing a buy-to-let, i.e. you're buying a property and renting it out to other individuals, but it becomes a house of multiple occupancy when there are 3 or more unrelated individuals living in a property. But believe it or not, you don't always need a HMO mortgage. Okay, so first of all, do you need a license on the property? You're about to get a Jamie York special. My famous drawing of houses are well known on YouTube by now as being the worst houses ever drawn. So if you've got a property here, now if you're renting it out, do you need a HMO? Well, actually, in order to get a HMO license or warrant getting a license, there's 3 things. And if these 3 things are covered, you must have a HMO license. First of all, are there 5 or more people in the property? Is the property over 3 floors? And do they have shared facilities? Now, if your property and your tenants are ticking these 3, you must get a HMO license and you need to apply to your local council. Jamie, if they don't tick those 3, does that mean I don't need a HMO license? No, there's no guarantee around that. You need to check with your local council. All I can tell you is if you have these, you must have a license, okay? And if you are getting a licensed property, you will need HMO lending. Just more on that in a moment, okay? But sometimes you can have in some areas 5-bed properties over 2 floors and you need to get a license. And most of those will be in what is known as Article 4 areas. If you go on your local council website and you type in Article 4, it will show you. So Leeds, has LS1 to LS28, and you'll see it on the map like this. Again, not an artist, not pretending to be, never will be. So this is LS1 to LS28. It's very accurate, I assure you. Can we see it all the way down there? Yeah? No? Okay, let me just bring it up. Oh, now I don't even want to show it. It kind of looks like a mangled up brain. But there we go. So this is Leeds. So we've got LS1, LS4 over here, whatever. You get my point anyway. So some of this will be Article 4. And it will show like this. Now, a quick tip that I recommend you do is setting up a Google My Maps account, okay? My Maps. And what this My Maps account will do is you'll be able to have a map of your area, you put all of your postcodes in, and then what you can do on the left-hand side is you can go Article 4 and license area and stuff like that. It's a really cool visual tool so you can get a deep understanding. My business partner, Dan, massively geeks out on that thing. I let him spend the hours doing it. I just get the benefit of it. But seriously, it is incredible. So you need to check if it's in an Article 4 area. First of all, because then you'll almost definitely need it no matter what if you've got 3 or more people. But if it ticks these boxes, you definitely need it. And on top of that, you need to check in with your local council to see if you're going to need it in the first place. Now, do you put in an application and then it's guaranteed? No, you really don't. So what happens is, first of all, they'll give you a checklist. You need to tick all of these boxes and it'll be the fire doors, something to do with smoke alarms. It will be kitchen size and many more. Okay, so you need minimum size requirements and you will need to tick all of these boxes. And even then in an Article 4 area, they can still go, no. So in some areas, the Article 4, it's essentially You have prior approval rights or permitted development, which we'll get to another time. It's not for this video. But Article 4 is basically going, I don't care that you've got rights. we can take them away from you. Might as well be what it says, right? So what happens is, and this is the reason why, you can tell what this is already, can't you? Correct, it is a row of terrace houses. Obviously. They're just getting worse. So they're just getting awful property. I don't know what I'm doing now. So a row of terrace houses. Now here's what happens. You can understand it from their point of view. Let me bring it up a little bit for you. Is you've got your kids living on this street, family, you know, it's a family area. And then this guy here goes, you know what? I'm going to rent that to 5 students. And they're going to be getting pissed every day. These are the buckets of beer outside. They're partying on the street, doing what most students don't do at all. You get my point. And then what happens is this guy here goes, tell you what, that's doing pretty well, right? Why don't I do the same? Suddenly, Dave and Sarah, that's lived here for the last 420 years, are thinking, you know what? This street is starting to change. So the pros is the value of their property tends to go up because HMO prices are a lot higher. The downside is the quality of the life is definitely affected, okay? Hence where Article 4 come in to stop that. So they have a set percentage that they have on a street, and usually it's around 25%, but it depends on the area, where they're gonna go, no, you can't do this. So I'm gonna break down the mortgages, when you can get away from them, etc. But first of all, why even consider HMOs in the first place? Well, let's just go through these 2 scenarios. You've got this property, okay, it's a decent enough property, and what happens is you decide to rent it out to Dave. Dave is a great guy, happy to live in your property, and he's willing to pay you £700 a month. Now, that's pretty cool. We're going to look at gross figures. We won't net them down. And you go, well, that's pretty cool, Dave. Nice one. I'll take that. Thank you very much. That's $8,400 a year. Gross, not net, okay? 700 times 12, 8,400. But let's say, actually, tell you what, this is a nice property and it's got a hospital down the road. And we know that it's a training hospital as well. So they bring nurses in and they're there for a couple of years, but they know they're not there permanently. They've just moved there to be trained. But this is a nice 4-bedroom property. So why don't I rent out this property? Let's say you can rent out the rooms in this area, gross, for £450. Not too bad, right? A month. So now that's £1,800 per month. Now let's see if I could get my math right here. 1,800 times 10, 1,800, times it by 2 is 3,600, which is £21,600. So £21,600 per annum. Pretty good, right? Now we're talking. So why would we bother doing this when we can do that? Well, there's quite a lot of reasons. First of all, you need to have the right management in place. Are you going to get the right tenant demand? You need to furnish this property. Normally, you typically don't furnish your buy-to-let anymore. You used to, but tax changes, another conversation. So now we're renting out. You've got 4 people. The management's higher cost, bigger problems. This tenant hates that tenant. They trash the property. Wear and tear's a lot higher. You're probably netting about 50% more. So when you're £8,500 property, or 8,400, you're probably going to net close to 4,200. And that's from the mortgage, the wear and tear, the mortgage. Just trust me on the figures, not for this video. On this property, what we're probably going to be looking at is closer to about, my guess would be around 33% of this figure, okay? So we're probably going to be looking at about 7,200 of that, which again, if you add 50% onto that, works out at 6,300. So there or thereabouts. So cool. We make more money. But the other reason why people like HMOs so much is when it comes into commercial valuations. Now, this is where it gets really sexy, right? And why sometimes not having a buy-to-let mortgage is really going to help you. So let's break these 3 down. So we have buy-to-let, HMO, and commercial. And they are all slightly different. Now, at this point, I want to remind you that I am not financially qualified to give you financial advice. This is just my opinion, and you need to talk to a good mortgage broker. And when you're on the way there, watching this video, make sure to smash the like button, subscribe to the channel, hit the notification bell, because you love me. Moving on, buy to let. So why is it good? Well, the good thing is you're almost always going to be interest only. The reason why that's quite a positive thing in property is property valuations go up over time, so you don't really need to worry about being able to pay down the mortgage, and also it's the cheapest money ever, so you're only paying a low interest cost. Also, what you're able to do is you typically put in 25% deposit on that, so it is higher than a residential property. And typically, if you don't have a license, so no license, and it's 4 or less people, less than or equal to 4 people on the same AST, and you need to check this. AST is obviously your assured short hold tenancy, so your tenant arrangement. Sometimes the mortgage works used to be really good for this, for example. You can do that. So if you've got, and actually one of the first HMOs that I lived in was in Leeds, number 2 Haddon Place. There were 3 of us on that actually on the same AST. So you can typically do that, but you need to talk to your buy-to-let lender. You need to be really clear about your intentions of that to your buy-to-let mortgage broker, so that they can make sure of the terms and conditions. There are mortgage providers that will allow this on a buy-to-let, but it is a small selection. We're talking less than 10. Okay, so make sure in the small print you've got that. HMO is slightly different. Sometimes you've got interest only or repayment on there, so you can make a choice, but again, a lot of them go into the repayment model of when you're getting it down. Again, deposits vary, but you're typically at 25 to 35% deposit on that because of the increased risk. Now, just so you understand why it's an increased risk, if you default on your loan and the bank has to take the property back, what they're basing the risk on is, are they going to be able to resell the property? Now, if it's a buy-to-let property, pretty easy to sell on, right? If the tenant moves out, even easier to sell on. If it's a HMO property, a house of multiple occupancy, and you've got 4 or 5 people living there, how many people are going to buy that? You're talking a small section of the market there. So it's going to make it more difficult, higher risk. And they can't just kick out 4 or 5 people legally. They can't just do that, okay? So if you sometimes will still need it if it doesn't have a license. If it does have a HMO license, you 100% will need this. And typically it's going to be up to 5 rooms. So what you can expect with this is a slightly higher deposit. It's going to likely be a higher interest rate, but you are massively benefiting from the income coming into this property, okay? So you're gonna make more on a net basis. Just make sure you're getting a manager in charge of that. So again, really wanna push forward, talk to somebody that is financially qualified going this, because products change all the time. Then we've got commercial finance. So this is where it gets quite exciting. Again, your deposits usually are going to be higher. I'd expect 25 to 35% deposit. A lot of these are repayment. A lot more of them are repayment. There are some that are interest only, but a majority are repayment. You're going to expect higher interest rates. I'm talking closer to the 5%, okay? So I'm going to put 5%. You can get lower, but I'd expect higher amounts in there. Now, here's where it gets really cool. When you are valuing a commercial property, oh, and by the way, anything above 5 bedrooms, anything over 5 bedrooms, you are pretty much going to have to get commercial. There are some, but most people will get commercial. So here's the cool thing. When you value a residential property, i.e. a house, right, you are valuing it based on comparables in the area. When you are valuing it on a commercial, it's all to do with the tenants, okay? So what you have is something called, let me change the color here. Just go with black on here. So if we look at a commercial, what happens is you do something on a multiplier. So what happens is you have a yield in the area, and it's just a standard yield for that tenant type. So if in London, for example, you have the Bank of England that was a ridiculous example, but a bank renting your commercial space, is it safe to say that is a good tenant? Yeah, pretty safe. You are going to be really, really good there. You might get a 2% yield in there, okay? A 2% yield from that, which is a low yield because they are safe, okay? And remember, your yield fluctuates based on risk. Okay, I don't want to get too complex on that. Now, let's say the bank moves out and you're going to rent this property, the same property for the same rent to Alex, my videographer. Alex has decided videography, it's not for him anymore. He's going to set up a vaping store because that's what the cool kids are doing right now. Now, he's going to pay me the same. Let's say it's 50 grand per annum. Okay, it's all right. Alex has earned a mint off of me being my videographer and you guys signing up to my channel and going on the courses and stuff like that, right? So he decided he wants a vaping store. He's going to rent off me 50k. He's going to sign a 1-year agreement. Is it safe to say Alex might be a bit of a risky tenant to take in? He's shaking his head. He is. Okay, so the risk is higher. So it probably won't be this much of a fluctuation, but I think he's 10% yield. Okay, now here's what's amazing. If he's paying 50k and it's a 10% yield, how many 10s go into 100? 10. Okay, which means there's a 10 times multiplier. Now there are costs to factor in and stuff like that, but I'll do that as a breakdown in a further video. But keeping it simple, this is where it gets amazing. So 50 grand, how many go into 10? 10 of those. So that means the value of this property on a commercial basis is £500,000. Does that make sense? Makes sense to you, Alex? We're good. We're good? Watch it back, okay? So if it's a 10% yield, how many 10s go into 100? 10 times 50, 500,000. Now, all of you brokers watching right now going, oh, you haven't factored in this void period, this maintenance, all of that. I know it's just gross, okay? It will be less, but this is an extreme version. Now, if the bank moves in and pays the exact same money, is the property worth the same? No. So vacant, yes, because it's just based on a property value, right? What's the land worth? But the commercial value, now, it's not a property. It's a business. And businesses are valued differently. And this is linking back to HMOs, okay? So hopefully you're still with me watching this. So they're still paying £50,000 a year. The difference is they are really low risk. How many 2s go into 100? 50. Okay, so now we've got a 50 times multiple. This is like a huge, ridiculous proportion, right? So how many times does that go in? 50 times at 2%. So now 50 times 50,000 is going to be 5 times more valuable than this. £2.5 million. So this is a really extreme example here, and it won't be that big. It will be the difference between 7% and 11% in some areas, or 5% and 8%. But those percentage differences make a huge difference. So just by getting a different quality tenant in to my friends the bank and the rapscallion Alex and his vaping store, completely different yields, completely different risk, which goes in that. So how does this work for HMOs? Well, again, if you've got these different rooms upstairs, here's my beautiful drawings again. So you've got Dave, Sarah, Sally, and Trevor, and then you've got this little outshed with Alex in there, because that's where they keep him, right? If you've got these people in there, then what happens is you're gonna get this, oh my God, these drawings just get worse and worse, don't they? You're gonna get a commercial valuation on this, if it's on a commercial, okay? So what they'll do is, these people are paying 400 each, times the 5, getting 2,000, there's 24,000 each year. You'll probably take off about 25% by the end you're done with it, with the voids, the management and stuff like that. So where are we there? 6, 12, taking 6 off, so 18,000. Then there might be we're gonna call it a 10% to make it easy. It might be 10% yields in that area. And by the way, if you talk to a broker that knows this, and you know what, I'm gonna plug him, he doesn't even know I'm saying it, is Michael Primrose. Michael Primrose, check him out. He's absolutely brilliant for this. And he will know roughly what the multiplier is in that area, the yield is based on the quality. So if there's a 10% yield, and we're making 18,000 a year once we've netted down from the 24, what is the property going to be worth? 18,000 and 10%. 180,000. So that is the value of the commercial as you're coming in compared to a residential where it might be worth that. Now, whether you actually want to revalue at that is down to you, because there's obviously risks associated having a property valued at 180 that's only worth 140. Hopefully you're smart enough to realize that's a risky move in there. So that covers everything that we need to. So I know that I've deep dived around HMOs a little bit. You know, what is a HMO? When do you not need a license? When do you definitely need a license? And then we've gone over buy-to-let, HMO and commercial finance. So the answer is, do I need a HMO mortgage for a buy-to-let? It depends. And I know that's not the conclusion maybe you wanted, but sometimes it is right to do a buy-to-let. A majority of the time you will want a HMO mortgage, and a lot of the time you might want to look at the commercial valuations. Just be aware that people focus on the growth all the time, and actually the shrewd investors, they focus on the risk and the downside. And most of all, if you want to be an intelligent investor, putting yourself out there and getting results, you want to make sure to hit the subscribe button, the notification bell to this channel. And you know what? If this has added value to you, genuinely, I love it if you're getting in touch. Feel free to hit me on Instagram. Feel free to leave a comment below. I'll reply to every single one. And do me a favor to get this out to more people just like you that want the support, education, and help just by smashing that like button. And I love it if I see you in the next video.